Hi, my name is Scott Dahl. I want to thank you for tuning in to another one of my podcasts today. Obviously, I'm going to address this sell-off or this correction, which I believe it's a correction in an ongoing bull market. I want to address it, put it in perspective, show you a couple charts so you can have a better idea of exactly what's going on here. Today, I'm recording on March 10th, which is a Monday right after the market close. So let's take a look at these numbers. Let's take a look at this sell-off. First of all, I'd like to show you seasonals. This is from my friend Scott Brown, who is a fellow CMT. This is a chart of March. So you see the blue line is a typical pattern of March all years. We have a sell-off and some weakness into right where we are now, and then we see that the market moves higher and extends further to the upside. This gold is the first year of the presidential cycle. We see a sell-off right about where we are now. We see a rally, trade sideways, and then sells off again toward the latter part of the month, and then starts its rally. So there is some argument that this could be seasonal pressure, certainly from looking at this chart. This sell-off is what's called a unwinding of a crowded trade. And here's what I mean by that. Last year, over 30% of the return, the positive return of the S&P 500, which was up 23%, that was represented by the Mag 7 stocks. And if you don't know what the Mag 7 stocks are, Google it. I'm sure we all do by now. Those are the 7 stocks that were basically pulling the majority of the large company indices or the stock market higher. That's a crowded trade. The majority of the ownership is in a small number of stocks. Well, the crowded trade has a tendency to overshoot and undershoot. So it overdoes itself and then it sells off hard. And that's what we're experiencing. We're seeing the individual investor that's selling this market. They're selling their big winners because they want to either lock in profits or they're basically running scared. And that's a correction. Correction, the weak hands get out and the strong hands come in and they buy the stock and then it's reset. They move the market higher again. So that's what we're seeing is we're seeing a crowded trade, and it's going to overdo it on the downside. And one thing I think we're going to need to see now is we're going to need to see a complete washout. What do I mean by that? Well, we're going to have to sell off to a point of where there's virtually no selling left. We're going to have to see these markets get down to such oversold extremes that there's really nowhere to go but for them to bounce higher. And then that's when they'll go ahead and take off. So the positive side is in the fact that the institutions are coming in and they're buying. So institutions are typically the smart money. So they're seeing what I believe that they feel are opportunity here. Now, also you want to consider that the reason this feels or looks more painful than it is in the fact that we have not had many pullbacks. Last year, we only had one correction that was of 8.5%. The stock market typically averages 2 to 3, 5 to 10% corrections per year. Not typically, it does. And then it has one correction somewhere between 10 to 15%. And we didn't have that last year. The average correction per year is a negative 14%. That's all the way back to 1980. So we're due volatility, we're due corrections, and that's what we're experiencing. This is a market reset. This is the market. We're letting steam out of the market so the buyers can come back in and then have the power to continue this bull trend. Let's take a look at a few charts here. This is a chart of the Mag 7s, and you can see that this selling has been significant. This is down from its peak almost 21%. So you can see where that selling is concentrated in the Mag 7. Now, I will tell you this, that from a broader perspective, we've seen the average stock in the S&P 500 sell off more than 15%. And that is either positive or a negative sign. That would be a negative sign that's showing us that the breadth, which is necessary, we need breadth, we need strong participation by all the stocks in order for the bull market to continue. That's showing that perhaps the breadth is dropping, which it is, or it's what this could be is a sign that we're seeing the correction under the surface, and so maybe that the selling will slow down because what we're not seeing the actual selling that's occurring underneath. So that's a possibility. But you can see right here, the Mag 7 is down almost 22% for the year so far. But let's look at the other indices. This is a daily chart of the S&P 500. We've broken down out of the bottom of this sideways trend channel. Last time I said that it could go either way. The odds are it would break out to the upside, but it has broken down, and that's a negative sign. That's a sign that we could travel lower. Also, the S&P 500, the 200-day moving average, it's gone below that. That's not positive. And if you see this trend line that I've drawn in here, I'm going to shrink this chart up so you can see the trend line. So this is a trend line that started back in November of last year, the trend line of that's continuation of the bull market. we're below that trend line. That's not good. That's not a real good sign either, because there's not a whole lot of support once we clear through that trend line. So the sell-off could easily continue. However, I will tell you that this trend line, the trajectory was a little too high. You usually have a trend line right around a 45% trend, which this longer term trend line, see this one right here? Well, I'm going to get even more data. Here's October of 2022. So this is more of a normal trajectory for the bull market. So it got a little bit ahead of itself from this point going forward. So we could easily see more of a contraction in this space. I don't know if it has to come all the way down to this trend line or not. It looks like things are getting pretty oversold here. I'm not done selling, but it looks like they're getting there. So that would be an extreme stretch. However, anything's possible since we've broken these support areas. Now, we can see the NASDAQ is similar. Why? Because the NASDAQ is heavy with these Mag 7 stocks that everybody's panicking out and selling. But then if you take a look at the Dow Jones, it doesn't look that bad. In fact, today we closed. This is a daily chart of the Dow Jones. Here's your months, here's your price, and we're in this sideways trend. We found support not only at the 200-day moving average. Here's today's trade right here. Not only at the 200-day moving average, but kind of supported here at this trend line as well. So that's a positive. And then if you look at the RSP, remember the RSP is an equal weighted S&P 500. So that Mag 7 weighting, that heavy weighting of the Mag 7, it pulls that out. It gives each stock in the S&P 500 an equal weighting. Well, we're not that bad right now. We've got congestion here at the 200-day moving average, which is acting to support as we do the trend line. Eventually, I mean, the market can't go down forever, just like it can't go up forever. So eventually we're going to sell off, we're going to wash out, and then we're going to have the strong probability that we can turn around and continue this bull market. What do you do here? What do you do? Well, you don't panic sell, but you need to look at your portfolio. Everybody's got a different portfolio. If you've got some bad stocks in there, some laggards, some stocks that just aren't showing strength, you want to cull your portfolio. You want to get out of those, and you want to buy the strong stuff, or you want to at least create some cash so you have that opportunity to buy the strong stuff. But that's what you want. You need to look at. Everybody has a different portfolio. You need to look at these portfolio holdings on an individual basis. Secondly, something I want to point out is that the bond market. So bond market's a flight to quality. It's a safe haven. So a lot of times when people sell stocks, they move over and they buy bonds. So the bonds are well overbought and the stocks are very oversold. Overbought means, they can't, how much more buying can there be because they've attracted so much cash. And then oversold is how much more selling can we do? Obviously, it can only go down so far, and then the selling exhausts itself. Last seller's out, then the market can renew itself and go higher. So we are approaching some extremes, not only in the stock market, but the bond market as well. With that said, if you have any questions, you want me to take a look at your portfolio to make sure you're positioned properly, I'd be happy to do that. I will tell you that there are some sectors that are actually showing some strength right now. So it's not time to get completely out of the market, but maybe reallocate your money or at least take a look at things. You can reach me at 949-497-6366. And you can email me, scott@dowcapitaladvisors.com. Be happy to help you any way I can. And thank you for tuning in and look forward to another podcast. Thanks.